What drives price movements and financial market cycles? A non-rational view of investor psychology and social moods with my guest today, Mark Galasiewski. He is Chief Equity Analyst for Asia and Emerging Markets with Elliott Wave International. Mark, welcome.
Hi, Bob. It's great to be here.
Elliott Wave International, the name of your firm, is of course named after the famous Elliott Wave. Would you please explain to me what that is?
Sure. An American man named Ralph Nelson Elliott, in the 1930s and 1940s, discovered universal patterns that occur in financial market price charts, basically. And that's what we do here is we analyze these patterns with our eyes, but increasingly using computers as well, to help our subscribers. We are a publishing company, and we have products that we sell online, PDF and HTML form, that help our readers to anticipate trends and trend changes in financial markets. And Elliott was just brilliant for having discovered this work as early as he did. It was my boss and Elliott Wave International's founder and president, Robert Prechter, who revived Elliott's ideas in the late 1970s and founded Elliott Wave International, now ElliottWave.com, and popularized it again to the modern population.
But he saw it all the way back to 1930s. I mean, he had a view even back then, before everything that happened since 2 world wars, subsequently, all kinds of markets ups and downs. But as far back as then, he seemed to know what was going on. So what exactly was his perception? What was the pattern that he saw?
Right. Well, maybe another time we can go into the full range of Elliott Wave patterns, but today I'm going to go into one particular pattern and apply that to my particular area of analysis, which is Asian markets. In my seat, I cover markets from Turkey to New Zealand to Japan, that triangle. And so one pattern that I will show you later is called a contracting triangle, and it's relevant to the modern period. And the best way to explain it is to show you the examples. But basically, these are Elliott waves in a nutshell are universal patterns that appear at small degree, that is even on an intraday chart, to large degree, as large as several centuries in size, and perhaps even larger as far as we know. But for what we have price index data for, at least several centuries in length. And you can use these patterns to anticipate trend changes. It's not 100% perfect. No method of price analysis can give you 100% reliability, but we think it's the best thing available in the financial markets at present.
Okay, so let's get into it. Tell me
Sure.
exactly what this Elliott Wave is all about.
Sure. Why don't we go to the charts, because that's where we feel most comfortable, in fact, and that's where the best evidence is. I think this is one of my favorite charts when I begin talking and trying to convince people that markets move for non-rational reasons, not the rational explanations that you read about in the Wall Street Journal or in academia. And I'll explain. Let me give you some background on this chart. This is, as many of your readers may know, the MSCI Emerging Markets Index is an index of 1,400 stocks in emerging markets, that is developed nations, and they're denominated in as many as 26 currencies across at least as many countries. And what's extraordinary is that this particular index is denominated in US dollars. And yet, what I find fascinating about this is that from a technical analyst perspective, we begin to break out our tools and we start analyzing it. If you could go to the next slide, you'll see what I'm talking about. That we now have, here I'm applying a trend channel. So here you have these 1,400 stocks denominated in 26 currencies, all supposedly beholden to the decisions of corporate managers and individual, country leaders determining macro and microeconomic policy and decision. And yet, look at this. Look at the major peaks and troughs in this chart. They're touching this trend channel, this parallel, these pair of lines, parallel lines, almost pinpoint at how many? 3 points on the bottom line and 3 points on the top line. So my question to people, I challenge them, is if the market were truly rational, if it was truly chaos out there, guided by government policy and the Fed decisions, how is it possible that this index over a period of 30 years could accurately ricochet between these upper and lower trend channel lines? And our answer to that is that it would be impossible. Therefore, the market must be following some other logic other than rationality. That logic is non-rationality. But it does have, it's not chaos. There's a clear logic, and that logic is Elliott waves. In other words, that financial market prices are in fact patterned, that the booms and busts of history, and you're looking at several of them right here. You see a boom in the late 1980s and early 1990s in emerging markets, the bust into the 2000s, the up to the 2007 high, and then another bust following that sense.
Mm-hmm.
So even the booms and busts of history, things that we try to apply blame to, right, in the case of busts, and we credit policies and government policies for in terms of booms, even those things are in fact just part of a larger process that's inexorable. We've been through a bust period since the 2007 high in emerging markets, as you can see there, a sideways secular bear market. We now may be heading into a a boom period again. But
Mm-hmm.
what's interesting from our perspective, we not only guide people toward the twists and turns of the actual patterns in financial prices or from financial markets, but we also try to make sense of the social phenomena that attend those turns along the way. So if you go to the next slide, I'll give you an example that's very relevant to the present. The major epidemic disease outbreaks of the past 30 years, at least in the modern world or the developed world, SARS, swine flu, and COVID-19 occurred toward the end of these major corrections in the emerging markets index. SARS in Hong Kong, swine flu in Mexico, and COVID-19 in China. But
Mm-hmm.
they all have in common, significant bottoms and bear markets. And so, one could, from a an ironic sense, say, well, isn't it interesting? Are these buy signals? Are these buy signals for the stock
I don't
market?
know.
They
You would
certainly appear
think
to be.
you would think that maybe they had caused the dip, but it looks like they come at the bottom of the dip. It's
Exactly. And
very
so
interesting.
that's right. So
Yeah.
what's the causal relationship here? What we think is that it's actually the social mood and the social conditions toward the end of the bear markets that
Mm-hmm.
is actually creating these negative social conditions that give rise to the epidemics. And this is something that we've been trying to to tout into the press, but it's been very difficult because most people don't, they want to place blame. They want to see some policy failure that resulted in this. And what we're saying is, just like the markets themselves, which boom and bust on their own, do
Mm-hmm.
not need triggers or catalysts, these also occur in and of themselves. They're part of the pattern. Now, not every major decline results, as you see there, there's examples of major bear markets that do not coincide um, with epidemic disease outbreaks.
Mm-hmm.
But we could say this, and we can say the same thing, that it's not just epidemic disease outbreaks. We research all kinds of social phenomena, from war to terrorist outbreaks to styles of movies and popular music that tend to be prominent during periods of boom and bust, bull market and bear market, as we'll
Right.
say.
So,
And
so-called catalysts, so-called actions by the Fed, things like this, they don't actually trigger the change. They come after the change, or the change triggers them, in effect, you're saying.
exactly. You put it very well. What we
Mm-hmm.
say is that the Fed actually follows the market, and the market that we talk about in there is that if you actually look closely at the 3-month Treasury bills, you will see that the 3-month Treasury bills, a freely traded market, is actually leading most of the decisions. You can actually predict
Mm-hmm.
the decisions to come by the Fed just based on the action in the freely traded
Okay,
3-month
let's move a
Treasury
little bit
bill.
through these slides now. I want to make sure we have enough time to get through everything in this first part of our discussion. So you want me to move on then?
Yeah, sure. Go right ahead. This is just to say,
This is what you
the
were saying.
concept here is bear markets breed infectious disease, and it's not limited to infectious disease. Bear markets breed a lot of negative things in
Hmm.
society, but those are an expression of the bear market. They are not its cause.
Okay.
Yep.
Moving on.
Okay, sure. So now we were talking about what patterns. I wanted to introduce to your viewers and listeners the contracting triangle pattern, because we just viewed it in, I'm going to show you that it applies to emerging markets, but also to our discussion of China later, and other Asia and other markets in Asia. So the contracting triangle, this here was the idealized contracting triangle pattern. This is a sideways continuation pattern that you can see that it's got 5 subwaves labeled A, B, C, D, and E, which get narrower and narrower until they finally, the price breaks out of that sideways trend toward the end of it. And this particular image that we're looking at here was published in 1978 by my boss, Robert Prechter, and his co-author, A.J. Frost. And they, of course, took this from Elliott's work back in the 1940s. So this has been in existence. Everyone's known about this. What I'm going to show you today, and is we're going to apply this pattern. Try to memorize it as best you can there. And as
Okay.
we go to the next slide, I'll show you a forecast that I made back in 2008. This is a market somewhere in the world. It's a stock market, I'll give you that much. Some of your more observant listeners may already and viewers may already be able to identify it, but I'll give you a hint. It's part of my beat, which is in Asia.
Mhm.
And here we are at the bottom of the global financial crisis in 2008, and all I had to do, I was so excited because I knew that what I was looking at was a massive 18-year contracting triangle pattern. There you can see in the lower right-hand corner of the screen, the idealized pattern. And here I am looking at this market. And what
Mhm.
did I say? Well, I was very, very bullish because I knew that at the end of that pattern, which we can now go forward one, you'll see is labeled there A, B, C, D, E at the bottom of that 2008 decline. And I
Mhm.
knew that the next major move in the Taiwan index, in Taiwanese stocks, would be to new all-time highs. And
Wow.
so I was able to make that forecast. If you go ahead one slide again, there we are. There's
Okay.
my
There
forecast. Here
you
I am in
are.
my first year on the job, and I've got one of my best and favorite, most exhilarating forecasts ever. Here it is.
Good start. Yeah.
The Taiwan, yeah, it's great. It's a good way to
Uh-huh.
start. The Taiwan index is nearing the end of its contracting triangle, and therefore
Mhm.
the beginning of a new bull market to new all-time highs.
Uh-huh. This
October
is just a
31st, 2008.
flip. The first slide we saw where it was rising with the waves were rising, it's just like we just flipped it on its axis to create the contracting triangle almost. Is that feels like
Um,
that. Not
Yes, well,
quite, but
what you're about to see, if we now forward one slide more, you'll see the price action
now
since then.
we're headed back up
This
again. Yeah.
is, again, remember that dashed line it went higher after the completion of wave E down.
I
We
see.
label the end of the wave is labeled with so the 2008 low is the end of wave E down, and so after wave E completes, the prices then go in the opposite direction above the high of wave A. In this
Hmm.
case, what's labeled as high.
Okay.
So this is an application. It was a real-time application, one of my favorite, and I'm going to give your viewers an opportunity to do some more analysis by themselves. So if we go to the next chart, we were talking earlier about the MSCI Emerging Markets Index. Here we have. I'm going to give people an opportunity to make some actionable trades. Here we have, this is very, very useful because you can actually take these ideas home and say, maybe can make a buck or two in the market. This is the largest emerging markets ETF. It's called the FTSE Vanguard, the Vanguard FTSE Emerging Markets ETF. It's traded under the symbol VWO.
ETF exchange traded fund.
Exchange traded fund,
Hmm.
in this case in New York Stock Exchange. And I think some of your people can already see that there is a clear contracting triangle pattern. Just go ahead and stop the tape now if you'd like to. Go ahead and label it, print it out. But if we go to the next slide, we'll show you how it's done. There it is.
Sure enough,
There
there it
is
is.
a contracting triangle, just like the idealized. In this case, it's a special kind called a barrier triangle on the bottom, but it's a contracting triangle. And
Mhm.
you're also looking at, if you look at the date in the lower left-hand corner, it says April 2020. This is the exact chart I published in my newsletter on April 3rd, 2020. And so I was aware that then there would be a move up. And not only a move up. I mean, we're early. It's early days in this move up. This move up, just like you saw in that Taiwan index, it is going to move for at least a few years. We're talking new all-time highs above the the 2007 high labeled top on this chart. So it's early days. There's a lot of things that can happen in the short term, but what does this tell you about the prospects for economies in developing markets?
Hmm.
It's huge. It tells you everything you need to know, that there's going to be an improvement as this trend eventually gets going.
Yeah, and
And that's
again,
what,
let's stress that these are developing and emerging markets. We're not looking at charts for the developed world or for Western developed societies or economies at all.
that's
Although I
correct.
wonder if we'd be looking at the same Elliott wave patterns if we were. I don't know. Would we?
Well, I mean, major global markets tend to ebb and flow together, but they, as we say, they have different long-term wave patterns,
Hmm.
and so
Okay.
yep. So that's
All right. Did you want to move on from
okay.
here? Do you want
Sure.
to
Yeah. Yeah.
hold off at this point for the next part, or
No,
is
keep going. I think
more to
I've got
see?
another. If I remember correctly, we've got another example. That's right.
Here we
So
go.
here's emerging markets. There's a broad correlation between commodities and emerging markets, and I'm sure some of your listeners, many of your listeners, are probably involved with commodity trade and certainly global trade.
Sure.
So they may be interested in what's happening to Dr. Copper. It's considered an economic indicator.
Hmm.
And from my perspective, I think many of your viewers can see it already as well. This is a clear contracting triangle. Again, stop the tape and check and label it yourself. But if we go ahead to the next slide, you'll see how it's labeled.
There it
There it
is.
is, contracting triangle. It's the same pattern as in the emerging markets ETF that we just showed. So this is, in theory, it should be very bullish for, certainly copper, and that it coincides with the bullishness in emerging markets as well. And these patterns are not perfect. If I have to admit, if we were to fall below, in this case, the end of wave C, which is almost the end, basically the end of wave E, to
Hmm.
new below that 2016 low, I would have to reconsider this outlook. There would be possibly another pattern that would develop. But for now, this working assumption is that this is very bullish for copper and, by extension, the metal complex as well.
Hmm. Okay.
Okay.
You want to move on from here, or
Yeah, please. I think we can go ahead and do that.
next slide, or are we?
Yeah, next slide is fine. Nothing, yeah. And here I'd
Good
like
old
to
OPEC,
introduce
OPEC
the same.
plus.
Yes, OPEC plus. Yeah,
Hmm.
talking about commodities. I mentioned earlier that these patterns that we observe have significance for human society, not just for the financial prices, because they're basically certainly the stock markets are a barometer of the social mood. That's how we
Hmm.
view them. And so we find that toward the end of these patterns, toward the end of bear markets, toward the end of declining waves, such as we're seeing here, we see two contracting triangles, one in Russian stocks and the other in Saudi Arabian stocks. And it's right toward the end of this pattern, toward the end of wave E of the pattern, that we see this Russian-Saudi feud roiling the oil market recently
Hmm.
in March, causing supposedly a drop of 30% over 2 days in oil price. But from our perspective, we think the timing is very interesting and supports our view that actually this is a contracting triangle, because we know that toward the end of major declining waves in stock markets, a lot of negative news tends to erupt. And this is one. It's almost something that you can anticipate that something negative is going to happen.
Hmm.
It's in the realm of chaos as to what actually ours, it
Yeah.
seems. But
Well, they came to tacit agreement, although who knows how long that so-called truce will last, and so
exactly.
hard to say.
However, if I'm correct that the mood in both of these societies is going to be rising over the next several years, as
Yeah.
these triangles imply, you would expect that feud would moderate and eventually disappear over time.
Hmm.
Do you see? So
Yes.
you can actually begin to predict the behavior based on the pattern that you're anticipating in the stock prices.
Okay.
Okay.
You got more for us at this point, or
I'm trying to remember what I have next. Let's see
why
what's
don't we
next.
take a look? Why don't we take a? Okay, we're gonna. This is what I want to talk about in part two,
Okay.
right? So we'll
Yes.
move on, but I just have one quick question of a larger sense of the Elliott wave, and that is, I take it that it incorporates all those anomalies that we consider to be anomalies, the things we say, oh, it's never been this way before. There's never been a delinking of interest rates, inflation, unemployment, debt versus equities, stock market performance, these things we think are crazy that we've never seen before. All that, in your estimation, is encapsulated by the Elliott wave?
It's interesting. If you go back to 2008, we've seen a lot of unprecedented things before in the past, and yet somehow these waves tended, they found their way to where they were going.
Mm-hmm.
What I'm going to say, it may sound extraordinary, but all of those factors that you mentioned are basically irrelevant because you're thinking from the perspective of rational economics.
I've got to
From the
stop doing
rational
that.
you've got to stop doing that.
This
Exactly,
rational
exactly.
stuff has got to go.
If you understand, understand and accept that the social mood within each society is the primary driver of the stock market,
Mm-hmm.
and that social mood is going to find its way and going to be translated into price waves in a bull market or a bear market,
Mm-hmm.
depending on the juncture.
Social
That you don't have
mood.
to, you essentially don't have to worry about those rational causes that people worry about so much.
Social
It's
mood creates boom and bust, not the other way around.
That's correct.
That's what we're
That's correct.
trying to say here. Okay, well, this is a good point to bring us to the end of part one, Mark. We're going to talk to you again in part two, and we're going to bring all this round to a discussion of today with a particular emphasis on Asia and Shanghai Composite Index and what the heck's going on in China. But in the meantime, I just want to close this out. Mark Galasiewski, thank you so much for the education on the Elliott Wave, really amazing insights, and I urge our audiences to join us for part two. So